How do we think about year-over-year earnings growth? How do you think of the transition in terms of the market pricing in quad 3 and quad 4? It's basically a similar version to what you just described there in terms of how you risk manage and measure and map the transition as you crest and roll the peak in the GDP curve.
Yeah,
right?
well, earnings, don't forget, if you guys throw up the earnings table where you had the multi-year look, you can see that Q2 of 2016, 2 years ago, you can see, and I'll circle this so you can see it quite clearly, that earnings were negative on a year-over-year basis, especially in the sector that everybody and their brother, sister's brother, who are all related, are currently long of, okay, which is technology. So this is really the last, on a 2-year basis, which is the best back test that we can find, as relevant on a forward outlook basis for the growth rate, is Q2 was the last easy comparison. This is essentially the point on earnings. What gives you any confidence that earnings would have been as strong as we thought they would be? Well, because it was the last easy comparison, okay? So this one right here that I'm talking about, which is Q2 of 16, thanks guys for getting that up. You go to technology, which is right here, tech, right here. See these easy comparisons? Q2 16. Then it goes to +6, +12, +22. God, I mean, by the time you get to here, next year, you're going to be comparing against a +35.6. You don't have to have done macro for more than 2 days of a subscription to know that that is highly unlikely that this time next year that earnings will look remotely close, even in the stratospheric area code of that kind of a number. Meanwhile, Wall Street raises its numbers after they accelerate. Don't forget that, never mind 2 years ago, a year ago, Wall Street didn't have this anywhere close to their forecast. So what Wall Street does is they anchor on what just happened. They're like, oh, 35, 30, 23. Earnings growth is going to probably be what, 15, 20%? Let's slap this multiple on it, get a brokerage fee, keep a couple clients in here. Let's start to, I don't know, what are you going to do next? I mean, I actually think one of the best things that Steve Jobs left as his legacy was Tim Cook's ability to dance. I mean, these bankers can't dance. No. They're going to have to do a lot more to be able to get to these numbers as we go forward. So again, it's a lot easier to make the longer term call. And I think that's why we get so many questions. I mean, isn't it a great learning lesson though? For all you that wanted to get super duper bearish, we've had many of you that actually one chastised me for not being bearish enough after a decline. I'm like, dude, you're about to meet your maker on your first squeeze. Like everybody wants to get bearish at the right spot, right? If you know that's the forward outlook, then why wouldn't you be bearish today? It's taken me 20 years to learn the humility associated with this. You have to have a much better process than just saying, well, it's going to be worse tomorrow, so I'm just going to short it today. Again, after the last couple days, don't you agree with that? I've sucked for a couple days. I'd sucked a lot more if I was short the NASDAQ and the S&P 500, though.